This podcast is for educational purposes only and is not financial advice.
Welcome to the 15-Minute Investor. Today we're covering the surprising new CPI inflation data, the Federal Reserve's unconventional policy mix, and the significant political pressure mounting around the next Fed chair appointment.
Okay, let's just jump right in. Our mission today is a real deep dive. We need to get past that headline inflation number, which I have to say was a genuine surprise.
A huge surprise.
And we need to figure out what it actually means for interest rates going into early 2026. But I think the real story here is the political landscape, because the Fed's current moves just seem profoundly contradictory.
It's a dive into the economics for sure, but you're right, it's really about the political reality behind the money supply. And when you look at that latest data, the initial reaction is just shock. Inflation cooled way more than anyone thought.
So let's start there with those new government figures. Headline CPI, it came in at 2.7%.
Right, which was a big drop from the previous 3.0%.
And well below what analysts were calling for. I think the consensus was around 3.1%, right?
It was. And core CPI, the one that strips out food and energy, it did the same thing, dropped down to 2.6%. So on the surface, that looks like a huge win.
It does. But I think it's vital to make a distinction here that investors sometimes forget.
Oh, absolutely. Lower inflation does not mean prices are going down.
Exactly. It just means they're rising slower. You're still paying more than you were last year.
Your grocery bill is still going up, just not quite as fast as it was. It's a really crucial point.
So it's a moment for, let's say, cautious optimism, but definitely not a victory lap.
Precisely. And that caution is really warranted when you look at the longer-term picture. I mean, despite this good news, inflation has been incredibly sticky.
It has. We're 5 years into this now, and we are still well above the Fed's 2% target.
And that gap between, say, 2.7% and their 2.0% goals seems to be the hardest part of the race. They're struggling to close it.
Okay, so we get this better than expected news, inflation at 2.7%. How do the markets actually react? You'd think that would immediately send the odds of a rate cut soaring for the next meeting.
You would think so. The next meeting is January 28th. But the CME FedWatch tool, which tracks what the market is betting on, told a very different story.
And what was that?
The reaction was, well, it was surprisingly muted. That non-reaction is maybe the biggest signal here.
So give us the numbers. What were the odds of a January cut before the report?
Before the report, the odds were sitting at 24.4%, a little less than 1 in 4.
Okay. And after this big, surprising drop in inflation?
They barely moved. The odds only ticked up to 26.6%.
Wow. So less than a 2 percentage point bump. The market basically shrugged.
It completely shrugged. And that tells you there's some deep skepticism there.
What's the interpretation? That they don't believe the 2.7% number is real, or that they just don't think the Fed will act on it?
It could be a mix of both. Either they think this is a temporary dip and inflation will bounce back, or they simply don't believe this current Fed leadership is ready to pivot just yet. They're looking past the headline number.
Which brings us to the Fed's official stance. They haven't exactly been signaling aggressive cuts, even with this better data.
No, not at all. They've kept up this remarkably cautious posture. Their official projection is for just one single rate cut.
Just one.
For the entire year of 2026, 0.25%. And their official line is that they're more worried about the labor markets right now. That's the justification they're using.
Okay, so what's their story on why inflation was so high in the first place? If they think it's cooling now, what do they blame for the past year?
The official explanation from Chair Powell is basically tariffs.
Tariffs.
Yeah, he's described it as a one-time price increase. The argument is that the tariffs pushed prices up temporarily, but that's an external shock, and things should get much better in 2026 now that those effects are fading.
That's a convenient explanation, isn't it?
Yeah.
Basically absolves their own policy of any blame for the last few years of high inflation.
It does. It lets them say, our framework is sound, it was just this outside event, and now we can wait. But that framing sets up the biggest paradox of all, which is what they're actually doing right now.
Right, because their actions seem to be pulling in completely opposite directions.
Yeah.
It's like they're hitting the gas and the brake at the same time.
That's the perfect way to put it. Let's look at the two conflicting actions.
Okay, first they're cutting interest rates.
Which is, by definition, inflationary. It makes borrowing cheaper, it stimulates the economy, and it can push prices up. That's the stimulus lever.
But then at the same time, they've turned the money printers back on.
Yeah.
And we should be specific here. This is quantitative easing, or QE.
Exactly. They started back on December 12th buying assets to the tune of $40 billion a month.
$40 billion a month, that is not a small number.
It's undeniably inflationary. So if your stated goal is to get inflation down to 2.0%, doing both of these things at once, it makes that commitment seem highly questionable.
So the big question for you as an investor is why? If the goal is price stability, why are they pulling two levers that should, in theory, drive inflation higher?
Right.
What's the alternative motive here?
Well, the critical view from the sources we've looked at is that the focus might not be on the CPI number at all.
So what is it on?
It may be more about propping up the markets, giving a lifeline to the banks, and maybe most importantly, monetizing the national debt.
Can you just break that down for us? How does QE, buying those assets, help monetize the debt?
Sure. So when the Fed does quantitative easing, they are mostly buying government bonds, which is the national debt. By becoming this massive buyer in the market, they create artificial demand for that debt,
Which keeps the price of the bonds high.
and therefore keeps the interest rate the government has to pay on its debt low. In simple terms, the Fed is printing money to help finance the government's deficit. It's debt monetization.
And that makes their commitment to 2.0% inflation look secondary at best.
Secondary to supporting government borrowing and making sure the banking system has enough liquidity.
Right. This whole paradox leads us perfectly into the long-term view, and really the biggest event on the horizon for monetary policy, the replacement of the Fed chair in May 2026.
This is probably the most important thing for investors to be watching for 2026 and beyond.
Because President Trump is expected to nominate the replacement soon, and there's one thing all the top candidates have in common.
A unified belief. They all favor substantially lower interest rates than the current leadership, aggressively lower.
So no matter who gets the job, a massive policy shift is coming.
A massive and probably rapid shift.
Okay, we have to spend some time on the top three candidates because this is going to dictate policy for years. Let's start with the insider, Christopher Waller.
Waller's a current Fed governor, a voting member, so he's an establishment guy. He's seen as a long shot, maybe 15% odds.
And his view on rates?
He wants to lower them by a full 1%, from 3.75% down to 2.75%. He's seen as someone who maintains that appearance of Fed independence, which is appealing. He also has some interesting views on crypto adoption.
A full 1% cut is a very dovish signal. Okay, what about the leading candidate, Kevin Hassett?
Hassett is expected to be the most aggressive in cutting rates. The priority for him would be economic growth over a strict inflation target.
But there are some serious concerns about him, aren't there?
There are. The main one is independence. He's viewed as someone who would be, let's say, highly willing to follow presidential instructions, which is a huge red flag for the Fed's credibility.
And the sources say that even some Trump officials have questioned his skills, calling him just a messenger. What does that mean in this context?
Well, that criticism really goes to the heart of the job. The Fed chair isn't just setting rates anymore. They're managing a multi-trillion-dollar balance sheet.
Right, from all that QE we just talked about.
Exactly. You need deep technical knowledge of how the financial plumbing works, especially under stress. The worry about Hassett is that he might not have that hands-on problem-solving expertise to manage that complexity.
Which would be a huge issue during confirmation. Okay, so that brings us to the second leading candidate, Kevin Warsh. He's got experience, but there's a catch.
He does. He's a former Fed member, but the concern is that he's been out of the game for a while, over 10 years.
He's been doing what advisory roles?
Mostly advisory roles, sitting on boards, giving lectures. He hasn't been actively managing policy in this post-pandemic world with its massive balance sheet and all the new liquidity issues.
So for him, the question is he still up to speed with how the machinery actually works today versus a decade ago?
That's the central question. All three want lower rates. But for Warsh, that decade-long gap raises questions about whether he can handle today's very specific, very complex challenges.
So no matter who gets the nod, what's the big takeaway for an investor looking at 2026?
Expect a Fed that is laser-focused on cutting rates and cutting them significantly. And if the market is already skeptical about hitting that 2% target now,
a new, even more dovish Fed could just pour gasoline on the fire.
it could absolutely exacerbate the inflation situation in the back half of 2026 and beyond. That's the structural headwind you need to be preparing for.
Which is a perfect pivot to the last, and maybe most critical point for investors today. The skepticism around the official CPI data itself.
Right, because everyone listening who's been to the grocery store is probably thinking 2.7%. That doesn't feel right.
It doesn't. And the sources point to this big disconnect. The official inflation rate is 2.7%, but the money supply is growing at 6%.
And the critical viewpoint here is that this isn't an accident. The analysis suggests the government may intentionally understate the CPI rate for a very specific budgetary reason.
And that reason is KLAs, cost of living adjustments.
Exactly. By keeping the official inflation number low, they limit the mandatory pay raises they have to give out.
Let's break down the scale of that. How much money are we talking about?
Billions. There are about 70 million Americans on Social Security. If the true inflation rate was, say, 6%, the government would be legally required to give them all a 6% raise.
Which would be an absolutely astronomical cost for a government already dealing with a huge deficit.
Crushing. So by reporting the official number at 2.7%, they only have to give a 2.7% raise. It's a very effective, if cynical, way to manage public spending.
So for you, the investor, trying to calculate your real return on anything, you can't just trust that 2.7% number.
You can't. You have to look at other data, look at money supply growth, look at alternative measures. You have to understand that the official number has deep political and financial incentives baked into it. Your purchasing power is probably eroding faster than the headline figure suggests.
That is a powerful final thought. Okay, let's wrap this up with a few key takeaways from our deep dive today.
We've got 5 critical points for you to consider.
First, that headline CPI number dropped to 2.7%, which was a big surprise. But remember, prices are still rising, just not as fast.
Second, the market basically ignored that good news. The odds of a January rate cut barely moved, which shows a lot of skepticism out there.
Third, the Fed is using a conflicting policy, mix cutting rates, while also printing $40 billion a month in QE. This makes their commitment to a 2% inflation target look very questionable.
Fourth, looking ahead to 2026, the next Fed chair, regardless of who it is going to favor much lower interest rates, which could pour fuel on the inflation fire down the road.
And finally, and maybe most importantly, you should be critical of that official 2.7% CPI number. The argument that it's understated to save money on Social Security cost of living adjustments is a powerful one.
So always measure your own success against the real-world costs you experience, not just the official numbers you're given.
Thanks for listening to the 15-Minute Investor.